The NASDAQ is closed for regular trading hours, and the last reported price for Plug Power stock, ticker PLUG, was $2.49 USD, marking a drop of $0.24 or 8.79% for the session on November 13, 2025. This significant, deep red candle is a stark reminder of the underlying tension in the hydrogen space. The immediate expectation after the recent strategic pivot news, where the company announced plans to generate over $275 million in liquidity through asset monetization, specifically selling electricity rights to AI data center operators and suspending its Department of Energy DOE loan program activities to focus on higher return opportunities, was a sustained upward momentum. We saw an aftermarket jump after the earnings announcement and the initial strategy shift, but the reality check came swiftly with this sharp intraday decline. What the market is reacting to now is not the revenue beat, which was modest at $177.1 million versus $176.3 million expected, but rather the fine print of that strategic shift. The unexpected insight here, the thing most retail investors missed while cheering the AI data center connection, is the risk associated with walking away from the $1.7 billion DOE loan guarantee commitment. A 10Q filing confirmed that this suspension could adversely affect their access to low-cost federal financing, delay project execution, and potentially expose them to termination of the entire loan guarantee. That risk profile is a heavy anchor, and it's why the stock price gave back its gains so aggressively, shifting the narrative from a shrewd, capital-efficient pivot to a high-stakes gamble. The general belief among the hydrogen bulls is that Plug Power, with its long history in the material handling space, supplying fuel cells to major clients like Amazon and Walmart, is uniquely positioned to capitalize on the secular growth of green hydrogen. Proponents see the company as a true leader, building a fully integrated ecosystem from production with their GenEco electrolyzers to delivery and power generation. This expectation is fueled by big-picture, long-term trends, decarbonization efforts across the globe, especially in Europe where there is strong policy support, and the promise of a global hydrogen economy. However, the reality of the business has consistently been one of high capital expenditure, negative gross margins, and continuous cash burn. The common ground is acknowledging the company is a first mover in a nascent industry, but the deeper, contrarian take that forces a rethink is that the market is now demanding proof of near-term profitability over long-term vision. The recent asset monetization to raise cash isn't just a smart move, it's a necessary step because the cash balance had dwindled significantly, and the company is still deep in the red. The focus has been forced to shift from building the future to surviving the present. The fact that they are now trying to sell electricity rights to AI data center developers, a move that is smart in monetizing an asset and tapping into a high-growth sector needing resilient power, is a direct challenge to the previous perception that their future hinged entirely on a massive, federally backed build-out of hydrogen plants. Analyzing the recent stock movement, the volatility has been extreme. Over the last few months, the stock has experienced massive swings, including a dramatic surge of over 70% in October, driven by news of the CEO succession plan. Andy Marsh, the long-term chief, is being replaced by Jose Luis Crespo, and a financing deal that temporarily eased solvency worries. This kind of price action is typical of a heavily shorted stock. Current short interest still exceeds 30%, which is a significant headwind, but also a coiled spring for potential short squeezes on any major positive news. The volume on the day of the drop, well over 115 million shares, was substantial, indicating a high level of institutional distribution or aggressive profit-taking. Even with a slight beat on the adjusted loss per share in Q3, the negative gross margin and cash burn figures overshadowed the top-line performance. Revenue growth in the electrolyzer business, which was up 46% sequentially to $65 million, is a bright spot, showing commercial traction. However, the overall net loss remains enormous, signaling that the scale needed to achieve operating leverage is still far from being realized. This is where investors utilizing platforms like like Fidelity or Interactive Brokers for detailed fundamental analysis will see the tension clearly. Genuine commercial growth in certain segments is being completely overwhelmed by the cost of building out the necessary global infrastructure, which is a massive capital-intensive undertaking. To fully understand the current situation, we must look at what Plug Power actually does. The company is an integrated hydrogen ecosystem provider. Its core products include GenDrive fuel cells for industrial material handling, which replace lead-acid batteries in forklifts and other equipment, a market where they hold a strong, established position with major anchor customers. They also provide GenSure stationary power solutions and GenFuel hydrogen storage and dispensing infrastructure. Critically, their GenEco electrolyzers are central to their future, as they are key to producing green hydrogen at a commercial scale. Their business model relies on two main pillars: selling the equipment, fuel cells and electrolyzers, and selling the hydrogen fuel itself under long-term contracts. The problem has always been that they are a buyer of hydrogen when their own production facilities are not yet fully operational, creating a negative margin loop. They are essentially paying high-cost market rates for hydrogen to fulfill customer contracts, while their own low-cost green hydrogen production facilities are being built. This is the operational reality that has led to consistently poor financial results, a reality that the strategic pivot aims to correct by reducing reliance on high-cost, self-developed production in the near term and moving capital toward higher return opportunities. Historically, the stock has been a highly speculative asset, a sentiment-driven play on the future of clean energy. It has a track record of wild swings, surging on news of government funding or major client announcements, only to retreat as the market confronts the persistent lack of profitability. The stock's 52-week high of $4.58 and low of $0.69 perfectly illustrate this volatility. Institutional holdings remain substantial, with major firms like Vanguard and BlackRock holding significant stakes, which suggests long-term belief in the sector but also potentially contributes to the intense trading activity as institutions adjust their positions. Retail investors, many of whom manage their own portfolios through platforms like SoFi Invest or an individual brokerage, often buy into the narrative of green hydrogen being the inevitable future, overlooking the near-term cash flow issues. The analyst community remains split, with a consensus leaning towards hold, but price targets ranging from $1.50 to $7, which is an extremely wide spread that reflects the high uncertainty and binary outcome potential of the company's long-term plan. This makes it a difficult stock for quantitative systems like Schwab Intelligent Portfolios to easily categorize, as the risk-reward calculation is heavily weighted towards future policy and technology execution. Looking ahead, the future outlook for Plug Power is now intrinsically linked to the successful execution of its new, more financially disciplined strategy. The key catalysts for the stock will be threefold. First, the successful and rapid monetization of the electricity rights, which is expected to inject over $275 million in liquidity, which essentially buys them enough time to reach positive gross margins, which they aim to achieve on a run rate basis by the fourth quarter of 2025, and then EBITDA positivity by the second half of 2026. The second catalyst is continued strong growth and margin improvement in the core electrolyzer business, especially in international markets, demonstrating that the technology is in high commercial demand and is a viable product line. The third catalyst is the successful installation and ramp-up of their self-owned hydrogen production facilities in Georgia, Tennessee, and Louisiana, which are crucial for bringing down the cost of fuel sold to customers and improving overall fuel margins. The risk, which the market highlighted with the recent sell-off, is the potential loss of the DOE loan, forcing them to seek more expensive financing or delay large-scale projects. Another major risk remains the competitive landscape. While they are a leader, they are not alone. Companies like Bloom Energy are also pushing for stationary power solutions, and the entire hydrogen sector is reliant on favorable government policies and the continued cost decline of renewable energy sources. This brings us back to the expectation versus reality framework. The expectation is that their technology will eventually be profitable, but the reality is that the transition is extremely capital intensive and fraught with execution risk. The pivot to AI data centers is an attempt to create a high-return, quick cash flow reality to fund the long-term capital-draining expectation. The market is waiting to see if they can manage both. I want to hear your thoughts on this complex situation. Comment below and tell me, do you think Plug Power's pivot to selling electricity rights to AI data centers is a genius move for quick liquidity, or is it a desperate measure that signals deeper issues with their core hydrogen infrastructure build-out? In summary, the trading session closed with a significant drop for Plug Power stock at $2.49, revealing a lack of conviction in the wake of their strategic pivot announcement. The initial excitement over beating revenue forecasts and the promise of a more financially focused direction, including the unexpected tie-in with high demand